Our topic for this session is your intangible assets under IAS 30. So this is the loan asset that we will discuss in this subject, IA2. So let's start. Before anything else, we need to learn the recognition of an intangible asset. So how do we recognize an intangible asset? Generally, if that standard is an IAS standard, particularly uh, this standard is also a IAS standard, past 38. So an IAS standard follow the old recognition criteria. So what is the old recognition criteria? So the old recognition criteria gives you these items. First, it must meet the definition. Second, it is probable. Third, it is measurable. Okay, so the old recognition criteria is still applies on your old standards. So here, first we need to meet the definition. So for us to recognize an intangible asset, it must meet the definition of an intangible asset. So what is an intangible asset? An intangible asset is an identifiable non-monetary asset without physical substance. So it is identifiable, it is non-monetary, it does not have physical substance. So one important item here in your intangible asset is the physical substance. Why? Because if that asset has a physical substance, then it is property, plant, and equipment. So if it has physical substance, normally that non-monetary asset is a property, plant, and equipment. But if does not have physical substance, that is an intangible asset. So the distinguishing characteristic of an intangible asset from property, plant, and equipment is the physical substance. Take note, intangible asset does not have physical substance. Further, it is said to be a non-monetary asset. So when we say non-monetary asset, it does not really arise from contract, or you do not settle it on a future date based on a contract. So again, what is a money and a non-money asset? So when we say money asset, normally these are your financial instruments. So these are based on a contract. You have a right or an obligation arising from a contract. Here, intangible asset, normally you do not settle this in a future date. You do not need to pay a fixed amount. Okay? So no fixed amount that is needed to pay for this intangible asset or needed to be received out of these intangible assets. So it is considered non-monetary. So no fixed amount that based on a contract. Finally, it is identifiable. So when we say identifiable, it must be capable of being separated. So when we say it is capable of being separated, you can identify it separately among class of assets. Because if it's an embedded asset, then we cannot say it is intangible asset. Again, identifiable, it is capable of being separated. So you must identify it, or you can separate it among class of assets. So when it is embedded, we cannot consider it as intangible asset. So for example, you have here a purchase of investment in associate. So you purchase stocks. In that stock, the consideration you paid as compared to the fair value of net assets acquired, the consideration transferred is greater than your fair value of net assets acquired. So remember in your investment in associates, so this is the consideration and this is the fair value of net assets. Okay. So, 'di ba ang ginagawa natin consideration less fair value of net assets? If ever consideration is greater, we have a goodwill. You learn that goodwill is a type of intangible asset. However, this goodwill is not separately identifiable. It is only embedded on your investment in associates. This being embedded only and not separately or capable of being separated on that particular asset, it cannot be considered as intangible asset. So you do not separate it. It will still be placed in your intangible asset. Okay? So it will still be placed in your investment in associate. Okay, you will not separate that goodwill out of that investment in associate because it is not separately identifiable. So based on this definition alone, take note, one characteristic that we look into your intangible asset is the capacity of being identified. Another, it must be non-monetary without physical substance, because if it's non-monetary and with physical substance, it falls in the definition of a property, plant, and equipment. And once it is monetary, it cannot be considered as a fixed asset. Okay, so we already expounded that particular definition. Next, it must be controlled by the entity as a result of past event from which future economic benefits are expected to flow to the entity. So first, it must be controlled by the entity as a result of past event, and we have future economic benefits. Dito na pumapasok yung second and third criteria natin. It must be probable of economic benefits. And you can measure that economic benefits. So when we say probable of economic benefits, there are benefits that will be incurred. There are benefits that will be received by the company because of using that asset. Whatever that benefited, be it an income or be it an increase in goodwill, be it an increase in the production, whatever type of benefit, so long as it is considered an increase, then we can consider that as a probable economic benefit. Finally, you should measure that economic benefits. But take note, one item here that is pleased is control. Important item now in every asset is that you have that control. So ownership is not important so long as you control it. You already know that one. So long as you control it, ownership is not important. So for example, you have here an intangible asset that is only leased. Since you are controlling that economic benefits, even if you do not own that intangible asset, so long as you control whatever the benefit out of that asset is, then we can consider it as an asset. Remember, the definition of asset was already changed based on the definition in your conceptual framework. So it is not already ownership, it is the presence of control. So you control the economic benefits that will flow to the entity, and that economic benefits is probable and measurable. Okay, so after discussing this particular definition of tangible assets, we can already list down the essential characteristics of an intangible asset. First, it is identifiable. We say it is identifiable if it's capable of being separated. Another is the control. We must control the economic benefits. And lastly, the future economic benefits. So whatever benefit that will be given to the entity, so long as that economic benefit results to the increase or uh, flowing of economic benefits to the entity, then we can say that there is a future economic benefits. So what is an example of a future economic benefit? So for example, you have here a patent. What is a patent? Normally, a patent is given if in case you have a new idea and a new technology, breakthrough technology, let's say, and you need to secure that breakthrough technology so that you can only make use of it, you will patent it. So you patented a particular technology for your use only, and the technology will increase your future earnings. Therefore, the economic benefit on that is the increase of future earnings. Okay, so again, we need to look whether that particular asset has future economic benefits. Sir, what if there is no future economic benefits? You already know this one. In all assets that you discuss or that we discuss in your asset section, we learned that if ever there is no future economic benefit, it will be considered as an expense. But if there is a future economic benefit, we can consider that as an asset. So this future economic benefit is again a main criterion in recognition of an asset. So please take note in looking soon in your intangible assets. we need to look whether there is a future economic benefit. Okay? So, recognition criteria, again, meet the definition. It must be probable and it must be measurable. So, we're done now with one item of your intangible asset that we need to learn. So, again, what are the items that we need to learn in this topic? First, we need to learn the recognition. Next, we need to learn the measurement. So in your recognition, we said we have your three essential characteristics. First, it must be identifiable. Second, it must be controlled by the entity. And third one, there must be future economic benefits. This is based on the definition. Another criteria for your recognition, it must be probable and it must be measurable. Now we go with your measurement. Remember, as we go through your measurement, we need to learn about your initial and subsequent measurement. So for your initial measurement, please take note of your measurement criteria under your property, plant, and equipment because it is the same with your intangible asset, except for self-generated PPE. Okay. So do you remember your self-generated PPE? Self-generated PPE, we learned this one uh, using your borrowing costs. Okay. We learned your self-generated PPE using your borrowing costs, also known as your construction of a property, plant, and equipment. Here in your intangible asset, we do not have your self-generated property, plant, and equipment. What we have is research and development. So the self-generated PPE is known as research and development under your intangible asset. And the concepts under your self-generated construction of property, plant, and equipment is different as to your R&D. All other else are the same. Okay, so again, we go back on your measurement. On your initial measurement, whatever you have learned before in your property, plant, and equipment as a measurement basis is still applicable in your intangible asset. However, the exception to this is your self-generated property, plant, and equipment. Why? Because in your self-generated property, plant, and equipment, the concepts that apply in your property, plant, and equipment does not apply to intangible asset. Because what we have now here is your research and development. Okay? So as we go through, uh, we will not dwell much on your initial measurement already since that was already discussed prior. What we will only discuss now in your initial measurement is the research and development. Now, on your subsequent measurement, we will still discuss your cost and revaluation model. So, still the same in your property, plant, and equipment. What is only different with your intangible asset with your property, plant, and equipment? In property, plant, and equipment, there is a physical substance. In intangible asset, there's no physical substance. Okay? So, we will dwell now on your measurement of intangible asset. So measurement, initially we will measure it at cost. So how do we measure your cost again? It depends on the type of acquisition of that particular intangible asset. So was it purchased using cash? Was it purchased using notes? Was it purchased using exchange? Was it acquired using bonds payable? Okay, so I hope you still remember those items. So how do we measure your cost? It depends on the mode of acquisition. Cash, short term, long term, shares, whatsoever. Okay? Now, the subsequent measurement, still we have your cost model and revaluation model is still the same with the measurement criteria that you have in your property, plant, and equipment. So let's have a quick recap on what is your cost model. So under cost model, we have your cost, your initial measurement. We deduct the accumulated amortization. So what's different here? We have now the word amortization. So remember, if ever we are to uh, we are to transfer the cost of an asset to an expense. If that is a property, plant, and equipment, we call it amortization. We call it depreciation. Right? So as we transfer the cost of the asset to expense, what do we call your property, plant, and equipment? The transfer is called depreciation. How about in your what do we call this one? Exploration for and evaluation assets under PFRS 6. We call it your depletion. And then for intangible assets under PAS 38, we call it your amortization. So the process of transferring the cost of the asset to your expense, PPE, depreciation, exploration for and evaluation asset, depletion, intangible asset, amortization. What's the other term for exploration for and evaluation of assets? Wasting assets. Okay. So here in your measurement under cost model, we have your accumulated amortization. So your amortization is like your depreciation. Normally, we use your uh, useful life. Next, you have your accumulated impairment loss under your past 36. So we impair your intangible asset. And then we have your subsequent carrying amount. Now for the valuation model, we have your fair value. So what differs under cost and evaluation model? In cost model, whatever is the initial measurement, it will continue. However, in your evaluation model, we will always take a look as to the measurement of that particular asset. So what is the measurement? We know it as fair value. So we always need to measure the fair value of that particular asset. So fair value less still accumulated amortization less accumulated impairment loss will give us your subsequent carrying amount. So still cost, here fair value. So the difference between cost model and evaluation model, in cost model, it is initially measured at cost and subsequently measured at cost. In evaluation model, initially measured at cost, subsequently measured at fair value. And then you can deduct the amortization and impairment loss. I know that you already know this one when you learned about your property, plant, and equipment. Okay, so since I told you that your initial measurement under your property, plant, and equipment and tangible asset is the same. And what only differs is your research and development. It is but proper that we can now discuss your research and development costs. So we have here your research and development costs. So under your research and development costs, we need to learn what items should be capitalized and when to capitalize it. Okay, so we have here your research and development costs. When we say research and development costs, we try to make a new intangible asset and we try to develop that until that we can say it is already an intangible asset. So this is like a process of acquiring new knowledge, transforming that new knowledge into an asset known as intangible asset. So when we say you are into your research, meaning you are acquiring new knowledge. You are acquiring new knowledge of making or on making an intangible asset. Development, you are already transforming or developing that knowledge to make an intangible asset. So it's like your research phase until your development phase until you can say you have an intangible asset. So you have here two phases, research and then development phase. Now we have your research phase known as your research cost. So any cost incurred during the research phase is known as a research cost. Any cost incurred in your development phase is known as your development cost. Now, how do we treat this research cost and your development cost? So again, in your definition of your intangible asset, there must be a probability of future economic benefit. Now, on your research phase, since you are only acquiring new knowledge or you're looking into your new knowledge to transform it into a possible intangible asset, the probability is still uncertain. The probability is uncertain. So it means that we cannot really tell that there is an intangible asset that you can get future economic benefits. Since it is still uncertain, what should we do? It does not meet the definition of tangible asset because the probability nga is uncertain. Therefore, what we do, we expense it. We expense it. So here, the research costs will be expensed. In short, guys, all research costs are expense. All research costs are expense. You will never capitalize. You will never capitalize research costs. So anything that you acquire or anything that you uh, incur because of acquiring new knowledge will be expense. Now we go with your development costs. How do we treat your development costs? Under your development costs, the probability here is more apparent. So in short, it is apparent that perhaps there is a future economic benefit. So you can already see, kumbaga sa tunnel yan, nakikita mo na yung light na baka meron ng intangible asset. So in your development cost, probability more apparent. So does it mean that since it is more apparent, we can capitalize it? Guys, for development costs, I need you to be aware of that particular development cost because for development costs, not all development costs are capitalized. Not all development are capitalized. Take note, the word or the phrase used here is more apparent. It does not say probable. It does not say it is really probable. It only says it is apparent. You can say that it is probable, but it is not really probable. It's like almost there, it is almost there, but not quite. Parang ganon. So here in your development cost, since the probability criterion was not really established yet, what we do is we need to test it whether we will capitalize it or not. So not all development costs are capitalized. That's why there is an asterisk here in your capitalized area. So not all can be capitalized. Question is, when do we capitalize development costs? If you were under me in your conceptual framework and accounting standards, we have learned before that for us to recognize your development costs, we must meet this. Okay? We must meet I tae me. So what is this I tae me? So for us to recognize development costs or capitalize it, you must meet I tae me. Okay. So when to capitalize development costs? Take note, you must meet all of the following item. First, availability of resources. When we say availability of resources, all of the resources necessary or is required to complete that particular project is present. So for example, guys, you are to make a new technology. So let's say cell phone that can fly. Cell phone that can fly. Wow. So let's say you are to make a new cell phone that is really a breakthrough cell phone. So let's say you need a chip on that cell phone that lahat ng refresh rates is really so high using the chip. The performance is so high using the chip. So you need the chip on that cell phone. So the chip is really important. If the chip is not present as of the time of development, although it is now apparent that you can finish that cell phone, again, it is now apparent that you can finish the cell phone. However, we said that that particular chip that is needed to develop that cell phone is not present, then we cannot capitalize it. Okay? So although it is apparent, but there's no resource, the resource needed to finish it is not present, then we cannot recognize it. Another, you must have the intention to complete. This intention to complete really can be initially demonstrated based on your commitment. Based on your commitment. Next, we have your technical feasibility. When we say technical feasibility, it is really feasible that you can make use of that particular intangible asset after you finish it. So kailangan pagkatapos mo talagang ma-develop yan, feasible siya na magagamit mo, na pwede mong ibenta, na pwede mong gawing prototype, etc. Next, we have your ability to use or sell. This is part of your technical feasibility because, of course, it must be feasible that at least once you finish it, you can use it or you can sell it. Another is your economic benefits and measured reliably. We're done with this. You already know these two items, economic benefits and measured reliably. That is your probability and measurable criteria. Now, what we need to make an emphasis here is your availability of resources and your technical feasibility. Normally, guys, for research and development type of problems, what we need to look is the feasibility. Feasibility, okay? So, pagka computation problems yan, normally pagka sinabing it is already feasible, you can already capitalize the research and development. However, guys, take note again, for your theoretical part, all must be present. So the 6 items must be present, not only feasibility. But again, when it is problem solving, if you can see the feasibility item, you already capitalize it as part of intangible asset. Okay? So again, guys, theoretically, when do we recognize development costs? Research costs, we're done with that. We will expense it. Research cost is expense. While development costs, we can capitalize it. You can capitalize it if ever you can demonstrate I time E. That is theoretical under PAS 38. However, for problem solving, once you see that there is already a technical feasibility, you can capitalize it as intangible asset. Most problems take that as a uh, signal that you can already recognize an intangible asset. Okay, so if ever you are solving problems, you can see that once there is technical feasibility, most authors will recognize that already as intangible assets. So theoretically, ITA-ME, problem solving, when you see technical feasibility, okay na yan. Okay? So let's recap your research and development. So research phase, you acquire new knowledge. Development phase, you transform and develop that knowledge to make an intangible asset. So in a research phase, there is still not much evidence that you can really make use of that intangible asset. There is uncertainty whether you can create that intangible asset. Therefore, any cost incurred during research phase is expense. Now for development phase. For development phase, take note, not all development phase is expense and not all are capitalized. Because the rule in your research phase is that all research cost is expense. While for development costs, not all are expense, not all are capitalized. So the question is, when do we capitalize? We capitalize under your development phase if in case these items are present. Item, so all must be present. What are those? First, availability of resources. Next, you have your intention to complete. Next, we have your technical feasibility. We have your ability to use or sell, economic benefits, and measured reliably. So these 6 items must be present. So take note, guys. We can only capitalize if ITME is present, theoretically. However, for problems, if there is already a signal of feasibility, we can already capitalize. I hope we are clear under your research and development. So let's have an example. CDH company is developing a medicine delivery device. Total expenditures for the project was 7,500,000, of which 3.4 million was incurred before July 1, 2019. CDH company's management team determined that the device will generate probable future economic benefits and achieve technical feasibility as of July 1, 2019. So again, if that is problem solving, what is your signal? The technical feasibility. So guys, we have here 7.5 million pesos. So before July 1, 2019, and after July 1, 2019. So before July 1, 2019, you incurred 3.4 million pesos. So 4.1 million pesos is incurred after July 1, 2019. So what do we look into here? If there is already technical feasibility, we said we can already capitalize that. So before that, you expense. Okay. So the amount of development cost to be capitalized as an intangible asset is, so after technical feasibility, your answer is 4.1 million. Okay. I need to stress this one again. For development cost, it's just really looking into the ITAME. However, if that is a problem solving, once there is a technical feasibility, you can already capitalize the development cost. So our answer here is 4.1 million. So anything before the technical feasibility is expense, but anything after the technical feasibility or during the technical feasibility, it is capitalized. So 4.1 million pesos. Okay? So I hope we are clear here in our example of research and development. So we're done with research and development costs. We go now to other subsequent expenditures to learn more about your subsequent measurement of your intangible assets. So subsequent expenditures. If you still remember in your property, plant, and equipment, we have your revenue and capital expenditures. So revenue expenditures does not have future economic benefits, but capital expenditures has future economic benefits. So either increase in life or increase in efficiency or performance. Now, for intangible assets, do we still have revenue and capital expenditure, or we don't have those concepts? So in tangible assets, still we have your revenue and your capital expenditures, the same treatment. So again, just a recap, in a revenue expenditure, we say there's no future economic benefit, that's why we expense. While in your capital expenditure, we capitalize it because there is a future economic benefit. Okay, so I'll write it down: revenue expenditure and your capital expenditure. So in your revenue expenditure, we should always expense it, while your capital expenditure is capitalized. Okay. However, in your intangible assets, we have these rules under your subsequent expenditures. So although it is a capital expenditures, sometimes we still expense it. Okay. So under your intangible intangible assets, subsequent expenditures are considered an expense, except if it is probable and measurable. In short, there is a future economic benefit. So in short, guys, revenue expenditures and capital expenditures, as I said, it still applies under your intangible assets, although it is not straightforward as to the rule, but if we look closely, it's still capital expenditures follows the future economic benefits principle that is probable and measurable, and that is this one. Okay, so again, the rule: revenue expenditure that will not increase or will not make your asset efficient is expense. But if that is a capital expenditure, it is capitalized. So I hope by now you already know the concept of a future economic benefit. As early as your CFAS, you should already know what is a future economic benefit, because that will always be needed as to whether there is a probability or we can measure that particular future economic benefit. Okay, so subsequent expenditure is still the same rule under your property, plant, and equipment. So as you can see, guys, intangible asset really is like a copy of a property, plant, and equipment. However, again, in your intangible asset, it is different from your property, plant, and equipment because of the physical substance criteria, because intangible asset does not have physical substance, and there are different sets of intangible assets that needed to be discussed as compared to your property, plant, and equipment. In property, plant, and equipment, what you need to learn only is your land, building, and machinery. After you finish those three items, done. In your intangible assets, we have different kinds of intangible assets. So we need to learn each type of intangible assets and how do we measure it if ever it is purchased or acquired separately or it is internally generated. So again, if we talk about internal generation soon, please take note that is only research and development costs. And we're done with research and development costs. So please do not forego any concepts that you have learned previously. We go now to your subsequent measurement. So under your subsequent measurement, we have learned a while back that the subsequent measurement of an intangible asset can either be cost model or revaluation model. And what is the difference? As to the measurement. So cost model initially measured at cost, on your revaluation model initially measured at cost, subsequently at fair value. So either way, there is amortization, and either way, there is an impairment. So what is amortization? It is the systematic and rational allocation of the cost of the asset over the useful life. So as we said a while back, how do we transfer the cost of the asset to expense, or how do we allocate it? It is depending on the type of asset. So again, if that is a property, plant, and equipment, we place it as part of depreciation expense. If that is an intangible asset, we place it as part of your amortization expense. If that is a wasting asset or expiration for an evaluation asset, we place it in your accumulated depletion. And finally, to your cost of goods sold. Okay, so what is the amortization method? Normally, the different depreciation methods that you learned in your property, plant, and equipment, such as your straight line, double declining, 150% declining, sum of the years digit, production method, etc., is not applicable under your intangible asset. However, this standard only provides that you should amortize that you should amortize the intangible asset that will reflect the pattern of the economic benefits. Normally, guys, we only use your straight line method under your intangible assets. And straight line method is quite uh, easy for you because you just need to deduct the residual value from the cost. You divide it over the useful life. Okay, so how does your straight line method again works? Your cost or the fair value, depending on the model, less your residual value divided by useful life. Now the question is, what is the residual value? What is the residual value of the intangible asset? Okay, you learned before under your past 38 in your CFAS, the residual value of your intangible asset is always zero. The residual value is always zero. Why? Because guys, after the end of the useful life of that particular intangible asset, for sure, it does not have any use already. So for example, you have a technology that is invented today, come 20 years, that technology is already phased out. So what's the use of that technology already? Wala na. Therefore, generally, it is presumed to be zero. Remember that? I hope you still remember that. That the residual value of intangible asset is zero. What is the exception? What is the exception? Okay, so we said your residual value, general rule, it is presumed to be zero. What is the exception? First, if there is a committed third party buyer. So whatever is the commitment, the value or the price of the commitment is considered the residual value. Another, when at the end of the useful life, there is an active market for its residual value. In this case, you can already assume the residual value. Okay. So again, what is the rule? Unlike your property, plant, and equipment, at the end of the useful life of that property, plant, and equipment, what happens? You have a scrap value, meaning you can still sell it at a particular price, or you can still recover a certain value out of that property, plant, and equipment. However, for intangible assets, since this is more of an invention, at the end of the life of that invention, generally it does not have a value. Therefore, what will happen? You do not have any residual value. So residual value is zero. But the exception on this rule is that first, there is a committed third party buyer. So whatever is the commitment price, that is the residual value. Next, if there is an active market for its residual value, so there is a trading market or a market for your intangible assets, that you can assume the residual value of a particular intangible asset. Normally, we do not have an active market for an intangible asset, but there can be a commitment to sell that particular intangible asset, and whatever is the committed price, that can be your residual value. Okay, so again, cost model or evaluation model, we still amortize it. So in amortizing that particular intangible asset, how do we amortize it? We use your straight line method. So we get the cost or the residual value, we deduct the cost or the fair value, we deduct the residual value over the useful life. Now, we're done with this cost or the fair value. You already know that one. Now, our problem is the residual value. So, how do we estimate the residual value? Under the standard, residual value is zero as a rule, but the exception, if ever there is a commitment or there is an active market, then we can make a residual value. Sir, what if there is no commitment and there's no active market? Then it is zero. Sir, what if there is a commitment? Whatever is the committed price, that is the residual value. Sir, what if there is an active market? Whatever is the value of that particular intangible asset in that active market is the residual value. Okay, so you just need to look at these two items. So guys, please do not look into your residual value. Huwag ninyo nang hanapin yung residual value because again, it is presumed to be zero unless the problem states there is a committed buyer, therefore you can deduct residual value. Or there is an active market, you can deduct residual value. So I hope you are clear as to your residual value. Now, question is your useful life. What is your useful life for amortization? This now will be answered whether that particular asset has a finite or infinite life. Okay. So normally we amortize intangible assets, but when do we amortize? We amortize your intangible asset if it has a finite useful life. Meaning, there will always be an end on that particular intangible asset. So there is a useful life. So you amortize it over its useful life. It's infinite. It is not amortized but tested for impairment. It is not amortized but tested for impairment. So again, how do we test for your impairment? We get for the carrying amount versus the recoverable amount. Okay, what is the recoverable amount? The recoverable amount is the fair value less cost to sell and the value in use. So whatever is the higher between the two, that is the recoverable amount. I hope you still remember. The fair value less cost to sell is the current fair value of the asset less the cost of selling the asset. While your value in use, why is it called a value in use? It is called value in use because it gets the present value of the asset as you use it. So that's why normally in your value in use, it gives you the different values or different amounts that you can get out of the asset over its useful life. Normally, bibigay yan. If ever the asset has a 3-year life, it gives you values from year 1 to year 3 that you can estimate the asset as you use it. So you just get the PV. Whichever is higher, that is the recoverable amount. So you test it for impairment. Okay. So that's how we will compute for the recoverable amount. I hope you can still remember this one. So guys, under your present value of asset, please, I hope you do not forget your rules under your present value, rules under your present value or time value of money under your AE 103. What is that subject again? Finman. The Finman subject. I hope you still remember your Finman subject. How do you get for the present value? If it is equal stream of cash flows or unequal, or it is under perpetuity. If it's equal again, you just get for the present value of either ordinary annuity or annuity due, unequal. What do we use? Present value of 1. Perpetuity, how do we get for that? We just get for the value, we divide it to your rate, diba? If that is perpetuity. Therefore, guys, if that is infinite, we use your perpetuity. Okay. Again, we go back on our rules. Here, in your value in use, you get the present value of asset as you use it. Clear? Okay. But what's the problem in your infinite? If it's infinite, there is no estimated years. So, hindi mo pwedeng estimate yung present value for year 1 until infinite years, right? Because it is infinite. Therefore, how do you compute that present value? So, we go back on our rules under your present value. So, under your time value of money in your FinMan, you learned about these streams of cash flows. We have your equal cash flows, unequal cash flows, and perpetuity cash flows. So infinite goes to your perpetuity cash flows because the cash flows is infinite or perpetuity. So the stream is, we cannot estimate the stream because it is in perpetuity. So since it is in perpetuity, how do we compute now for your value in use? Value in use is computed as value divided by rate. I hope you still remember that. So as you go through here, how do we test the impairment of infinite? I hope you still remember this, okay? Because maybe you're asking, how do we compute for this? It is perpetual. How do we compute for the present value? Take note, since it is infinite or perpetual, you use the rule on your time value for perpetuity. You get the value, you divide it to your rate. Okay, so the year 1, year 2, year 3, or the values over the years as you use it is not applicable because it is infinite. So how about if it is finite, sir? How do we compute for your value in use? Since it is already finite, to compute for your value in use, you use the equal or unequal time value or present value. Okay? So I hope we are already clear here on your recoverable amount. Okay? So if we get the value in use, for finite, you can test it the present value using equal or unequal. If infinite, how to get for present value? Use the rule on perpetuity. Use the rule on perpetuity. What is new here only is the perpetuity because it has an infinite life. Napakadali naman yan, guys. You just need to divide the value over the rate. Clear? Okay. So, ayan, impairment of intangible assets. How do we impair or when do we impair your intangible assets? We impair your intangible assets for finite intangible assets if there is an indication of impairment. When is there an indication of impairment? Normally, guys, if ever the question is, what is the impairment loss? Normally, there is an indication of impairment on a problem. So, what is the real indication of impairment? Per figures, we compare the carrying amount to your recoverable amount. If your carrying amount is greater than your recoverable amount, we have an impairment. Okay? If your carrying amount is greater than your recoverable amount, we have an impairment. Okay. If infinite, when do we impair it? You impair it annually or when there is an indication of impairment, but normally annually. Annually. Okay. So, under the rules in your past 36, when do we really impair? If there is a significant volatile changes or there is insignificant volatile changes as to the values of the property, plant, and equipment or the intangible asset, we need to consider those items. But normally, if there is an indication, we impair it. So, when is there an indication? If the carrying amount of the asset is greater than the recoverable amount. If the uh, carrying amount of the asset is greater than the recoverable amount. Okay, let's have a quick recap on what we have discussed today. So we have discussed for the recognition and the measurement of intangible assets. So for recognition, we have discussed your definition of intangible assets, which gives us the three essential characteristics. So what are the three essential characteristics again of your intangible asset? First, it must be identifiable. Second, you must control it. And third, there is a future economic benefits. So aside from that recognition criteria, we also have these two items. That is your probable and measurable. Okay. Take note, it must be identifiable, meaning it can be separated, capable of being separated so that we can identify it. If it is embedded, we cannot recognize it as an intangible asset. So although there is no physical substance, what is important is the identifiability. Now we go with your measurement. So under your measurement, we have your initial measurement. For initial measurement, generally, what we need to look is whether it is purchased or acquired. So when we say it is purchased or acquired, we apply all the rules that we learned in your property, plant, and equipment. Is it purchased at cash, short-term credit, long-term credit, at a particular discount, issuance of bonds, exchange, issuance of shares, those items. And another mode of initially acquiring that asset is through your internal generation. So when we talk about internal generation, what do we have again? We have your rules on your research and development. We have your rules on research and development. So under your research and development, research cost, expense, development is capitalized. We capitalize your development cost. But when do we capitalize your development cost? We capitalize your development cost only, guys, if you meet the ITME criterion. And what is the ITME criterion? We have your availability of resources, intention to complete, technical feasibility. We also have your ability to use or sell, economic feasibility or economic benefits, and lastly, measured reliably. That's for theory. But for problem solving, if there is technical feasibility, it is already okay. Okay. Next, after your initial measurement, we have your subsequent measurement. How do we subsequently measure it? We have your cost model and your revaluation model. Your cost and revaluation model is still the same as to your cost and evaluation model under your property, plant, and equipment. So cost is initially measured at cost, while revaluation model is initially measured at cost, subsequently at fair value. But both has your amortization and your impairment. So how do we amortize? We amortize if ever it is finite. So if that is finite, how do we amortize? That is your cost or your fair value. You deduct your residual value, you divide it to your useful life. So what is the residual value? The residual value is generally zero. Residual value is generally zero. But if ever there is a committed buyer or there is an active market, we have a residual value. Now for impairment, we can impair whether it is also finite or infinite. If it's finite, you test for impairment when there is an indication of impairment. If it's infinite, you test for impairment at least annually or when there is an indication of impairment. Now question is, how do we get for the value of your impairment? So to get for your value of impairment, we compare the carrying amount to your recoverable amount. So your recoverable amount is the higher between the fair value less cost to sell and your value in use. For your fair value less cost to sell, always take note, this is the current value of the asset when you sell it, less any cost to dispose that asset. While your value in use is the value of the asset through its continued use. Now, your problem here in your value in use is how do we estimate the present value? For finite, you can estimate the present value over the years because you can just get for the PV using PV of 1 or PV of annuity, either ordinary or annuity due, based on the stream of cash flows. While for infinite, the infinite here is that the stream of cash flows is also infinite. Therefore, what we need to get as a present value is your perpetuity. So the present value using your perpetuity. So how do we get for the present value using perpetuity again? We get for the value and we divide it to the interest rate. Okay? But take note that is only on the portion of your value in use. You still need to get for the higher between fair value less cost to sell and value in use. So that's it for your recognition and measurement of your intangible assets.